This is my quasi-emergency video that I want to release today because a lot of people are reaching out saying, Ari, should I just own the S&P 500? And my answer is always yes, and there's a real risk if you don't own other asset classes as well. So I'm the host of the Early Retirement Podcast. That's all I do. I help people retire early because you don't just need this income for the next 30 years. It's not the traditional retirement from 65 to 95. It's, hey, none of us know how long any of us are going to live, but I want to make sure you have income for the next 40 plus years of your life. Now, you've heard the diversification word, I'm sure, many times before, but I want to show you it in a whole new light and why it's not entirely your fault if you've been invested mainly in the best parts of the market, which historically over the last 10 years has been those large growth companies. So I'm going to make myself smaller here because this is a really important point. Now, here's the actual tool, one of the tools, that I'll use with my clients to show them how we look at portfolios. So we'll keep it super simple here. Let's just assume from 2023 that we're looking at a 23-year time period. I use this for round numbers to make it easy. The reality is I can pick any time period. I could go back 50 years, whatever we want. But just to make it super simple, from 2023, you can see this is how this portfolio would have performed. So check this out. That's a 23-year time frame in this example. Now, let's look at this. Let's assume you have $2 million. A lot of you have saved and invested well. You're retiring early. You know that you need in that, 2 million plus range. Maybe there's not a pension there. If there's a pension, maybe you don't need quite this amount. Depends how much that you want to spend. But this is where a lot of people reach out to me. This is what they have. So let's just put this in here. $2 million, and I'm going to assume in this first example, before I illustrate the real point here, that you don't withdraw any money. So super simple, everything right here, portfolio number one, everything is in 100% US large caps. So let me clear this, and you're going to see the following. If we analyze the portfolio, here's what you're going to see. Is your $2 million, and call it January of 2000, it grew and grew and grew, and it became $9.5 million. But I'm going to guess you don't want to just have that money grow and grow. You're going, Ari, I need to live off of this fund. I need income to come from somewhere. And don't get too dogged down into the details of, Ari, is it coming from a Roth IRA or IRA? Because I do a whole separate video on that where I'll talk about, hey, if we need $80,000 a year to live, do we have to take out 100 or 110 to be able to end up with 80,000? So we'll talk about that. But the account is certainly important here. But in this example, we'll just assume you have $2 million, and let's just assume it's all in an IRA. Okay, so it's growing, and after 23 years, it would be worth $9.5 million. This is assuming it's all in the S&P 500. And you can see here, we can see there are certainly some downturns, some very good years, everything in between. Now, if we go back up here and say, okay, we've got $2 million, but Ari, I'm retiring, and I need this income to last for a very long time. I want to pull $80,000 a year. What happens if we do that? Well, then I'll go here. I'll say, let's analyze the portfolio again. And now here's what you're going to see. Here's where we are. January of 2000, you retire. You need this income for 20, 30, 40 plus years. Well, it's going to be really tough because you can see right here we have $2 million. And now all of a sudden it's really going down in an unhealthy way, unhealthy direction. And 23 years later, you have $738,000. Now, number one, it assumes that you take out $80,000 every single year. Most of you know this from listening to the podcast. You won't take out $80,000 every single year. Some years, maybe a whole lot more. Other years, less. Well, you have your energy and health that you might want to travel more and spend more. And I encourage that. At the same time, I don't want you to overspend and then kick yourself later because of long-term care or other concerns, which all leads to the ultimate question of, are you going to be okay? So here's where we are. This is that first example. You're not running out of money, but I'm going to imagine you need this money for a very long time, not just 23 years. So now let's go up here and look at the following. Is what if we said, you know what, instead of just having everything in US large caps, what if we had a growth allocation? So you can see some large cap, some mid cap, some small cap value, some REITs, real estate investment trusts, some international portions of the market, and a little bit of fixed income. So an 80-20 portfolio overall. And then what if we say the same thing here? You have $2 million, you want to withdraw $80,000 every year. When we analyze the portfolio, this is powerful to me, is the S&P 500 is going in one direction, which is down, of course, and not a fun one. Now, if you had a growth portfolio, so you're still getting tremendous growth, you can see here that you're actually projected to end with $3.2 million, even though I've added a 20% buffer of what I call a war chest. You can see if I go back up here, I'm actually adding treasuries in here. So you can see I'm adding 20% of what I call fixed income, what most people call fixed income. I call it a war chest. War chest is super safe assets you don't have to worry about. It plays a role in the portfolio. And here you're 100% equities, but the problem is the following. There are years where there are significant downturns. And if you just have the S&P 500, which you can see here is the blue, when the market's down 9% in 2000, you're still withdrawing 80,000 a year. So markets go down and you're still pulling income. That plays a big impact to your portfolio long term. With the red portfolio, you can see in 2000 you'd only be down less than 1%. And so yes, you're still withdrawing income, but here's the power. Is if the S&P 500 is down, you go, I don't care. Ari, I've got enough in other places that it's going to be okay. I can pull from it if I need to. So are there going to be years where the S&P 500 outperforms the traditional growth portfolio? Yes, look at this right here, 2013. S&P 500 up 32%. You are the red here. You would have only been up 18%. Yet you can see you still end up with so much more money. This is a night and day difference. And that's because you have a different place to pull from, and that's what makes this so powerful. We can take it one step further, and you can see all the different details here of, in the first portfolio, S&P 500, you have $2 million. 23 years later, you have $738,000. You can see annual growth rate is negative 4.14%. All these different cool metrics here, standard deviation, what was the best year, the worst year, the max drawdown, and a few other cool things that I go through with my clients. But you can see here, if we add one more layer to this, and I just like to do this to just emphasize my point, is if you said, let's have a conservative portfolio. So you can see here, conservative portfolio, I'm putting 48% in the US bond market, 12% in global. So call it a 40-60 portfolio. Not one that I'll often recommend, but just so you can see for illustration purposes, is that would be the orange line here. So the orange line, you can see here, you started with 2 million, you ended with 2,085,000. Now, I always ask my clients the following, and I think it really resonates when I tell this quick story. I promise I won't go into too much detail, but it's important. There's a definition of conservative out there, and we can look it up, and I'll do it with you actually right after this. But the definition of conservative is very different to different people. So I'm going to make myself larger here to further illustrate my point. I asked one client, I said, what does conservative mean to you? They said, Ari, conservative means that I don't have to experience a ton of ups and downs in the market when I'm retired, because I know I don't have a ton of time to recover if a downturn occurs. I said, okay, that's very fair. Let me ask another client an hour later, and I did this. I said, what does conservative mean to you? They said, Ari, conservative means I didn't leave any money on the table unnecessarily. It's not saying I'm going to be happy, Ari, with the ups and downs of the market, but I don't want to look back going, wow, I could have had 1.2 million more dollars or retired 2 or 3 years earlier through just good planning. So it's not numbers I'm obsessed with. It's getting the most life out of these numbers. And so if we look up conservative, quite simply, you're going to see a definition here, which is fairly straightforward. And I show this: adverse to change or innovation or holding traditional values. And to me, adverse to change is really important, which is why I want to bring this up. Sorry, averse to change. This here, I'm going to make myself smaller, is a really important distinction here. This difference of understanding whether it's $3.2 million with a good quality portfolio, whether it's $2 million or whether it's $700,000, most people don't reach out because it's, Ari, am I going to be okay? It's, I worked really hard to save to my 401k. I have a healthy pension. I have rental income. There's going to be Social Security, and there's timing considerations with all of that. But with an early retirement, you need this income for 40, 50 plus years, and I'm going to guess you only want to retire early once. Most people don't want to have to go back to work. Now, if you want to add part-time income and do some other things, whether it's consulting in any capacity, I have a different software I show my clients and how I use this. But the overall message here is don't subject yourself to concentration risk. Now, the last thing I want to do, because I'm not married to any idea, is I want to show you the following. What if you said, Ari, what if we didn't pull any from our portfolio? Like, we've got $2 million and we have a pension that covers all of our needs. I say, great, what would that mean? Let's analyze it, and here's what you're going to see. And so I'm all about showing both sides. You can see here, I'll make myself smaller once again. You start with $2 million. The orange is that conservative portfolio. Your $2 million turned to $6.5 million. And you can see the red portfolio here. It's kind of hard to see, I know, I'm hovering over it. Your S&P 500 of $2 million became $9.2 million. But the diverse growth portfolio became $9.5 million. The real risk here is that markets don't perform well. The S&P 500 doesn't do what we expect it to do. And all of a sudden, now the graph has that one blue line here going downwards, like I just showed you. However, it's not as if we're leaving a ton of upside on the table. So let me just refresh this once again. You can see, yep, what if we wanted to take out not 80,000, but 100,000, just as an example here. Analyze the portfolio, go back down here, and here's what you see. Is all of a sudden that S&P 500 is showing us running out of money 2016, 16 years later, if we want to take out 100,000 every year. However, you can see here that you still had $1.7 million in the growth portfolio, and the conservative still had 1.4. We can shift this once again. Maybe it's not 80,000, maybe I need 70,000 from the portfolio. I say, great. And these are the types of things that I'm doing with my clients to show you that when we run projections, it's not about how do I die with the most amount of money. It's how do I make sure I never go back to work? How do I make sure I am going to be okay and that I don't leave anything on the table unnecessarily? So this is what I wanted to show you, a really helpful tool. But beyond all of that, this is investments. That's all I really talked about just now. And historical performance and the risk of concentration risk and why diversification is so important. But I want to take it a step further because this doesn't talk about IRAs and 401ks in specific and Roth IRAs and tax planning. So I'm going to do a whole nother video specifically for that. The next few videos are going to be less of me just kind of speaking at you. I know to me, it's a conversation. So ultimately, I want to make sure this is as fulfilling, as important to you, and that it's resonating. Because my job is to make sure I'm coming up with the most creative content that hopefully makes you go, wow, I'm thinking a little bit differently about my early retirement. I'm a little bit more confident. It's not going to flip overnight, where all of a sudden, Ari, I don't know if I'm going to be okay, and now I am okay. But there are going to be some flips along the way where you're going to flip the light switch and go, wow, I do need to diversify, because if I don't want to subject myself to tremendous risk. So this is just investments. This isn't how we withdraw income. This isn't tax planning. This isn't insurance or estate planning. I'll do different videos on that. But I wanted to switch it up a little bit, give you a different style, and let me know if this resonates with you guys. Lastly, of course, I love helping people create a custom strategy to retire early. If this is of any interest, where you're going, yep, I need this with my portfolio. I need to see, am I going to be okay? Am I optimizing? That's, of course, what we do. So reach out to myself. You can see that link in the description below. Thank you.